On January 3, 2020, the United States assassinated Qasem Soleimani, Iran's most powerful military commander. Oil spiked 4% overnight. Gold jumped above $1,575 an ounce. Lockheed Martin and Northrop Grumman surged 3 to 5% before the opening bell even rang. Every headline said the same thing: war with Iran. Two cousins in Newark, New Jersey saw those headlines that morning while waiting in line at the same bodega they hit every day before work. Marco was 34, a delivery truck driver for a medical supply company. His older sister had talked him into opening a brokerage account 5 years earlier, 100 here, 200 there, more when overtime was good. He'd built it to $47,000 in index funds. That money was the backbone of a down payment on a two-family house in Ironbound. Live in one unit, rent the other, build something real. When he saw those headlines, missile footage, World War III, Marco pulled over on his route and sold everything through his phone, all $47,000, cash. He called his wife and said, "I'm not watching our house money disappear because of a war." His cousin Ray was 31, a mechanic at a tire shop on Ferry Street. Same sister's advice 2 years later. He had $41,000 saved to open his own garage someday. Ray saw the same headlines, same footage, same talking heads. He did nothing. Actually, that's not quite true. He moved $3,500 from savings into his brokerage that Friday and bought more of the S&P 500 while Marco was panic selling. He texted Marco one line: "Bro, every time they say this, nothing happens." And within days, the market recovered completely. The S&P 500 was higher by the end of January than it had been before the missile ever launched. By the time Marco felt safe enough to get back in, the market had already moved 8% higher. He re-entered at prices above where he sold. Then COVID hit 6 weeks later. The S&P 500 crashed 34% in 23 trading days. Marco panicked again, went back to cash again, and missed the fastest recovery in stock market history. By December 2020, the market was at all-time highs. Ray's portfolio had recovered and then some. Marco's was still down because he'd been in cash during the two sharpest recoveries of the year. Same headlines, same morning, same fear, same family. Marco locked in losses twice. Ray stayed invested and ended the year up 16%. Marco spent that Christmas doing math he wished he'd done in January. 2 panic sells, 2 mistimed re-entries. Total cost approximately $7,600 in missed gains. For a guy driving a delivery truck, that wasn't abstract money. That was closing costs on a house, not lost from a bad investment, lost from reacting to headlines. Ray ended the year with just under $48,000. By spring of 2021, he signed a lease on a small garage bay in Elizabeth. Marco was still trying to rebuild what he'd given away for free. This wasn't luck, it was a pattern, one that has repeated with almost mechanical precision across every major geopolitical conflict since World War II. Pearl Harbor, Korea, Cuba, Vietnam, the Gulf Wars, September 11th, Russia, Ukraine, Israel, Hamas, same pattern every single time. And right now, as U.S.-Iran tensions are escalating again, that exact same pattern is setting up. The question isn't whether it will play out. History says it will. The question is which side of it you'll be on. I'm Ben, and on this channel we don't predict the future, we study the past, because the past has a habit of telling you exactly what's coming, if you know where to look. Today, I'm going to walk you through 80 years of data, expose 3 critical mistakes that destroy retail investors during every conflict, show you the exact 3-phase pattern institutions use to profit while everyone else panics, and give you a concrete framework for positioning your portfolio right now. Let's start with why Iran specifically matters more than almost any other geopolitical flashpoint. It comes down to a single narrow body of water, the Strait of Hormuz. Approximately 20 million barrels of oil pass through this choke point every day, roughly 25% of all global oil supply. Iran sits on the northern shore, producing 3.3 million barrels of oil on their own. Any disruption, or even the perceived possibility of one, sends shockwaves through global energy markets, and energy markets move everything else. Here's the chain reaction. Conflict creates perceived oil supply risk. Oil prices rise. Higher oil means higher inflation. Higher inflation means the Federal Reserve can't cut rates. Higher rates mean higher borrowing costs for every corporation in America. Lower costs mean lower profits. Lower profits mean lower stock valuations. Lower valuations mean your portfolio drops. That chain reaction from a missile in the Middle East to your savings takes about 48 to 72 hours. It doesn't care about your politics or who started it. But here's what the headlines never tell you. That chain reaction has a shelf life, and historically it's a very short one. The fear is real, but the damage to markets is almost always temporary, unless the supply disruption becomes physical and sustained. I went back through every major geopolitical conflict since 1941 and tracked what the S&P 500 actually did, not what pundits predicted, what actually happened. Here's the pattern across 20-plus events. During the initial shock, the S&P drops an average of 5 to 6%. That shock typically bottoms within about 20 trading days. The market fully recovers to pre-crisis levels within roughly 45 to 50 trading days, and the 12-month forward return? Positive in over 80% of cases, averaging 8 to 10%. Let me walk you through the record. Pearl Harbor, December 1941. The market dropped approximately 10% initially. Then the U.S. entered a massive industrial expansion, and the S&P gained significantly through the war years. Korean War, June 1950. The S&P dropped roughly 12% in the initial weeks, recovered within months, finished the year higher. Cuban Missile Crisis, October 1962, the closest the world has ever come to nuclear annihilation. The S&P dropped about 7%. Once the crisis resolved, the market rallied 30% over the next 6 months. 30% after we nearly ended civilization. That should tell you something important. Markets don't price in what happened. They price in uncertainty about what happens next. The moment uncertainty resolves, even if the resolution is bad, markets move forward. The market doesn't reward the person who reacts fastest. It rewards the person who panics last. Vietnam War escalation, 1964-65. Brief market dip on escalation. Markets generally rose through the mid-1960s because war spending fueled economic growth. The problem came later. Inflation became the real killer, not the conflict itself. That's exactly the chain reaction I described earlier, playing out over years instead of months. Gulf War I, 1990-1991. Sharp initial decline. The S&P returned 11.7% per year during the war itself. In the 12 months after it ended, the market returned 18%. September 11, 2001. Markets closed for 4 consecutive trading days, unprecedented. When they reopened, the Dow dropped 14% in a single week. Within 2 months, the S&P had recovered to pre-attack levels. Defense stocks rallied massively. Gold began a multi-year bull run from $270 an ounce. Iraq War 2003, brief dip. The S&P rose 13.6% within 3 months. Russia-Ukraine 2022, the S&P dropped 7% initially, rebounded above pre-invasion levels within a couple of months. Israel-Hamas, October 2023, S&P dipped on invasion news, then rallied so hard through Q4 that it became one of the best quarters in recent memory. The Soleimani assassination, the closest historical parallel to current tensions. Oil spiked overnight, defense stocks surged, gold jumped. Within days, everything normalized. Days. Marcos sold everything and missed it all. Ray bought more and rode the recovery. Even Kosovo in 1999 barely registered because the dot-com bull market overwhelmed geopolitical fear. North Korea's fire and fury tensions in 2017 caused a brief VIX spike, and the S&P finished up 19%. The Falklands War dipped and recovered in weeks. The invasion of Panama, the market hardly flinched because swift, decisive action eliminates uncertainty fast. This pattern doesn't hold sometimes. It holds nearly every time, over 80 years, across different presidents, enemies, weapons, and economic conditions. The pattern persists because capital processes uncertainty the same way every time. Now, I wouldn't be doing my job if I didn't tell you about the exception, the 1973 Arab oil embargo. After the Yom Kippur War, OPEC physically cut off oil to the United States, not a perceived threat, an actual, sustained, physical removal of oil from the market. The S&P dropped 17% and did not recover quickly. It took roughly 2 years. Why did the pattern break? Because the supply disruption was real, structural, and sustained. It caused stagflation and coincided with compounding problems like Watergate and the collapse of the Bretton Woods monetary system. This distinction matters enormously. What would make the current U.S.-Iran situation look like 1973? An actual physical closure of the Strait of Hormuz for an extended period, sustained removal of millions of barrels from global supply, a wider regional war pulling in Saudi Arabia, the UAE, and Iraq simultaneously. If the conflict stays at the level of targeted strikes, sanctions, and proxy skirmishes, like the Soleimani strike, like Gulf War I, the standard pattern will almost certainly hold. Unless you see physical, sustained closure of the Strait of Hormuz confirmed by shipping data, not by cable news anchors, the base case remains shock, repricing, rotation, recovery. Now here's the part that frustrates me. Every time a geopolitical crisis hits, retail investors make the same 3 mistakes, every single time. Mistake number 1, they move everything to cash. This feels safe, it feels responsible, but what it guarantees is a loss to inflation while you miss the recovery that history says is coming within 45 to 50 trading days. You sell low, sit in cash, and by the time you feel safe enough to re-enter, the market has already moved 8% higher. Mistake number 2, they freeze. They stare at red screens, refresh their brokerage app every 11 minutes, watch cable news on loop, and do nothing productive. Freezing isn't a strategy, it's the absence of one. Mistake number 3, the most expensive one. They chase whatever just spiked. Oil is up, buy oil. Defense stocks surging, buy defense. They buy at exactly the moment institutional investors are selling to them. They become exit liquidity for Wall Street. Institutions do the exact opposite. They reposition based on known patterns. While retail investors are glued to war coverage, institutional traders are reading money flow data and quietly moving billions. Here's a principle that sounds cold but will protect your money. Markets are sociopaths. They don't care about your feelings, about geopolitics, about justice. They care about pricing risk and processing information. That's it. Marco wasn't stupid, he was scared. A guy with $47,000 representing years of sacrifice, who made a decision based on emotion instead of evidence. The data, 80 years of it, told him to stay put. He listened to the headlines instead. Every conflict follows 3 distinct phases in the markets. Once you see this framework, you cannot unsee it. Phase 1, shock. Lasts days to weeks. Oil spikes 5% to 30%. The VIX surges above 20. Risk stocks drop hard. Gold rises. Defense stocks spike. Financial media goes into 24/7 panic mode, designed to keep you watching, not to help you invest. This is the phase where Marco sold. Critical rule: do not buy oil, gold, or defense stocks during the shock phase. You will be buying at the top. Every historical example confirms this. Phase 2, repricing, lasts weeks to months. The panic subsides. The market shifts from asking what happened to is this temporary or structural. Focus moves to inflation trajectory, Fed rate decisions, and supply chain disruption. Institutions begin repositioning in size. This is where Wall Street makes its money, not in the chaos, but in the clarity that follows. In January 2020, repricing happened within days because the conflict's scope was immediately understood as limited. This is the phase Ray was operating in. He recognized a shock event with limited structural impact and acted on evidence instead of emotion. Phase 3, rotation, lasts months to quarters. Money rotates from losers to winners. After 9/11, this phase created an entire security and surveillance industry. After the Gulf Wars, energy infrastructure investments paid dividends for years. After Russia-Ukraine, European defense spending commitments generated multi-year tailwinds. The rotation phase is where patient, historically informed investors separate themselves permanently. Goldman Sachs research has shown that missing just the 10 best days in the market over a multi-year period can cut your returns nearly in half.
When do the best days typically occur? During the most volatile periods, right after the worst days. If you're sitting in cash because you panicked, you will almost certainly miss the snapback days that generate outsized returns. Marco missed both, the post-Soleimani recovery and the post-COVID recovery, two of the fastest upward moves in market history, and he was in cash for both. Let me get specific about asset classes. Energy and oil stocks. According to Bank of America's analysis covering 90 years of geopolitical shocks, oil was the single best performing asset class, averaging a gain of 18%. But that outperformance typically fades within 6 months. Oil is a short-term play. You need an exit strategy before you enter. Energy infrastructure, the smarter play. Pipelines, storage facilities, transportation companies, these are toll collectors. They don't need oil to stay elevated. They need oil to keep moving. Less volatile, more sustained returns. Defense stocks, already up roughly 34% from recent tensions. That might feel like you've missed it. You haven't. Defense spending operates on multi-year procurement cycles, 10-year contracts with backlogs in the hundreds of billions. Diversify across multiple contractors rather than concentrating in a single name. Gold and silver. Bank of America's data shows that 6 months after a geopolitical shock, gold outperforms by an average of 19%. Unlike oil, gold tends to stay elevated rather than mean reverting. If oil is the short-term play, gold is the longer-term positioning. Companies with pricing power, the one most people miss. During the inflation phase, companies that can pass increased costs to consumers survive and thrive. Strong brands, high gross margins. These don't just survive shocks, they consolidate market share while weaker competitors struggle. What gets pummeled? Utilities and real estate. Both suffer in a higher for longer interest rate environment, which is exactly what the chain reaction creates. Now, everything I've described is useless without risk management. Here's the framework. Rule 1. Keep your core holdings intact. Your core should be companies with strong pricing power, recognizable brands, and high gross margins.
Rule 2. Position sizing. Never go 100% into any one sector. Tilting your portfolio is intelligent. Concentrating it is gambling. Rule 3. Do not panic sell. The data across 80 years says you recover. Selling during the shock phase is the single most expensive decision retail investors make repeatedly. Ask Marco. Rule 4. Stop watching war coverage. Every piece of information you need is visible in money flow data, price action, and the historical record. War coverage is designed to maximize fear, which maximizes viewership, which maximizes advertising revenue. It is not designed to help you make financial decisions. When you see a red chyron saying, breaking, tensions escalate, your amygdala fires, your cortisol spikes, and your prefrontal cortex, the part responsible for rational decision-making, goes partially offline. That's neuroscience. Financial media exploits this biological response for ratings. The antidote is data, historical context, and a plan made before the crisis. Marco made his decision watching live missile footage on his phone, pulled over on the side of his route, heart pounding. That is not the state of mind for financial decisions. Ray made his based on pattern recognition. Every time they say this, nothing happens. One cousin acted on adrenaline, the other on evidence. Let me bring this full circle. In January 2020, when Soleimani was killed, the investors who did well weren't smarter or connected. They simply recognized a pattern that has repeated for 80 years, kept their emotions in check, and let history do the work. The people who panicked and sold lost. Marco lost $7,600 in missed gains, closing costs on the house he and his wife had been saving for. The people who chased oil and defense stocks at the spike bought the top. The people who understood the 3 phases, positioned in energy infrastructure and gold during repricing, and held companies with pricing power through the volatility, came out meaningfully ahead. Ray came out ahead. By spring of 2021, he signed a lease on a garage bay and started building the business he'd been saving for. Same headlines, same morning, same bodega, same family. 2 completely different outcomes.
The only difference was what each of them did with fear. Right now, as U.S.-Iran tensions build again, I'm watching the same setup form. The Strait of Hormuz, the oil supply fear, the defense stock chase, the cable news panic. It's the same movie I've watched 20 times in the historical record. I can't tell you whether this escalates into something resembling 1973 or resolves like 2020. Nobody can. But I can tell you that in over 80% of historical cases, the market was higher 12 months later. The average recovery takes 45 to 50 trading days. Gold outperforms by 19% at the 6-month mark. Oil fades. Defense spending runs on decade-long cycles, not news cycles. This is public data. It's not a secret. It never was. The gap between people who build wealth during geopolitical crises and people who get destroyed by them isn't intelligence, it isn't access, it isn't timing. It's pattern recognition. It's having a plan before the fear hits. It's knowing that the VIX spike will fade, the oil surge will mean revert, the gold move has legs, the defense cycle runs in decades, not news cycles, and broad markets recover within 2 months in the vast majority of cases. You've now seen the pattern across Pearl Harbor, Korea, Cuba, Vietnam, the Gulf Wars, September 11th, the Soleimani strike, Russia, Ukraine, and Israel, Hamas. You've seen the one exception and know exactly what conditions would trigger it. You understand the 3 phases, the 3 mistakes, and the sectors where capital actually flows. The question is simple. Next time the headlines start screaming, will you be Marco or will you be Ray? I'm Ben. This is Financial History That Pays.